Many small business owners believe accounting policies are only necessary for large corporations. In reality, every business, regardless of its size, benefits from having written financial rules. Accounting policies help ensure that transactions are recorded consistently, employees follow the same process, and financial reports remain reliable month after month. In this video, you will learn how to create accounting policies in business finance with practical examples. What is an accounting policy? An accounting policy is a written rule that explains how a business records and reports its financial transactions. Think of it as the company's financial rulebook. Instead of allowing different employees to make different decisions, the business establishes one standard method that everyone follows. For example, imagine your business sells office furniture. A customer places an order today, but the furniture will not be delivered until next week. Your accounting policy may state that revenue is recorded only after the furniture has been delivered to the customer. That means every employee records similar transactions the same way every time. The result is consistent and accurate financial reporting. It is also important to understand the difference between an accounting policy and an accounting procedure. An accounting policy tells you what rule must be followed, while an accounting procedure explains the steps for following that rule. For example, your accounting policy might say that every supplier invoice must be approved before payment. The accounting procedure would then explain who reviews the invoice, who gives final approval, where it is stored, and how the payment is processed. Without accounting policies, different employees may record the same transaction differently. One accountant might recognize revenue immediately, while another waits until delivery. One manager may approve large purchases without documentation, while another requires written authorization. Over time, these inconsistencies create inaccurate financial statements, confusion, and unnecessary risk. Strong accounting policies eliminate guesswork. They create consistency, improve financial reporting, and make it easier for business owners to trust the information they use when making important decisions. Also, make sure that you don't miss the practical business example included in this video. The biggest mistake many business owners make is trying to write one accounting policy for the entire business. In reality, every major financial activity should have its own policy because each area has different risks and different reporting requirements. Start by listing every activity that affects your business finances. Think about everything that involves money entering or leaving the business. For most small businesses, the list includes sales, customer payments, supplier purchases, operating expenses, inventory, payroll, fixed assets, bank transactions, and owner withdrawals. Each of these areas should have clear financial rules. For example, your sales policy should explain when revenue is recorded. Your expense policy should explain when expenses are recognized. Your inventory policy should define how inventory is valued and how physical stock counts are performed. Your fixed asset policy should explain which purchases are treated as long-term assets instead of regular expenses. You should also create policies for cash handling, customer credit, supplier payments, and monthly bank reconciliations. Even if your business only has a few employees today, these policies become increasingly valuable as your company grows. A simple exercise is to imagine hiring a new accountant tomorrow. Would that person know exactly how your business records sales, expenses, inventory, and equipment purchases? If the answer is no, those are the areas where written accounting policies are needed. Create your core accounting policies. Now that you have identified the financial activities in your business, the next step is creating clear accounting policies for each one. The goal is not to write a complicated manual. The goal is to create simple rules that every employee can understand and follow consistently. Let's begin with the revenue recognition policy. This policy explains exactly when your business records revenue. For example, if you own a furniture store, your policy might state that revenue is recognized only after the products have been delivered to the customer. If a customer pays a deposit before delivery, that payment is not immediately recorded as revenue. Instead, it is recorded as a customer deposit until the order is completed. This approach keeps your financial statements accurate and prevents sales from being overstated. Next is the expense recognition policy. This policy determines when expenses are recorded. Imagine your business receives an electricity bill for this month but plans to pay it next month. Your policy may state that the expense is recorded when the bill is received because the business has already used the electricity. This provides a more accurate picture of the company's monthly operating costs. Another important policy is the inventory policy. If your business sells physical products, you should define how inventory will be valued. Many businesses choose the first in, first out, or FIFO method. Your policy should also explain how often inventory counts are performed, how damaged products are handled, and when obsolete inventory is written off. Clear inventory rules reduce errors and improve profit reporting. Your fixed asset policy is equally important. Suppose your business purchases a new delivery van, manufacturing machine, or office computer. Instead of recording the full purchase as an expense immediately, your policy should explain which purchases are treated as long-term assets, which depreciation method will be used, and the expected useful life of each asset category. This keeps financial reports consistent from year to year. Then create a cash handling policy. Every business that receives cash should establish rules for counting cash, making bank deposits, recording receipts, and performing daily or weekly cash reconciliations. Cash is one of the easiest assets to lose through mistakes or fraud, so strong controls in this area are essential. Before we move on to the practical business example, let's first talk about something that's just as important: defining responsibilities and documenting everything clearly. Even the best accounting policies will fail if employees do not know who is responsible for following them. Every policy should clearly identify who performs the task, who reviews it, and who gives final approval. For example, imagine an employee wants to purchase new office equipment. Your policy might state that purchases up to $500 can be approved by a department manager. Purchases between $501 and $5,000 require approval from the finance manager, and anything above $5,000 must be approved by the business owner. With clear approval limits, employees know exactly what is expected, and expensive purchases are less likely to happen without proper authorization. The same idea applies to customer invoices, supplier payments, payroll processing, inventory adjustments, and bank reconciliations. Each responsibility should belong to a specific person or role instead of being shared by everyone. Clear ownership improves accountability and reduces the chance of errors. Once your responsibilities have been defined, document every accounting policy in writing. Your document does not need to be lengthy. A simple one-page format often works well. Each policy should include the policy name, its purpose, the actual rule that must be followed, the employee or department responsible, the effective date, and the review date. This makes it easy to update policies as your business grows or regulations change. Finally, remember that accounting policies are not documents that sit in a folder and are forgotten. They should be reviewed regularly, discussed with employees, and updated whenever your business introduces new products, services, software, or financial processes. When policies are clearly written, responsibilities are well defined, and every employee follows the same standards, your accounting system becomes far more organized, reliable, and scalable. A practical business example. Now let's see how accounting policies work in a real business. Imagine you own a small coffee shop that sells coffee, pastries, and sandwiches. On Monday morning, a customer orders catering for an office meeting and pays a $500 deposit. According to your revenue recognition policy, that money is not recorded as sales because the catering service has not been completed yet. Instead, it is recorded as a customer deposit. On Friday, after the food is delivered, the deposit is moved to revenue because the business has now earned the income. Next, the coffee shop purchases coffee beans, milk, and bakery supplies from a supplier. Your inventory policy states that all inventory is valued using the FIFO method. The inventory is recorded when it arrives, and a physical inventory count is performed at the end of every month. Any expired milk or damaged food products are removed from inventory and recorded as inventory losses according to the policy. Later that week, the business purchases a new commercial espresso machine for $8,000. Instead of recording the entire purchase as an operating expense, the fixed asset policy classifies it as equipment. The machine will be depreciated over its useful life using the company's chosen depreciation method. This produces more accurate financial statements because the cost is matched with the years the machine will generate revenue. Employees finish their weekly shifts, and payroll is processed on Friday. Before salaries are paid, payroll hours are reviewed by the store manager and approved by the owner. This follows the approval policy and helps prevent payroll mistakes. At the end of the month, the accountant follows the month-end checklist. Customer payments are verified, supplier invoices are reviewed, bank accounts are reconciled, depreciation is recorded, and the financial statements are prepared. Every task follows a written accounting policy, so there is very little confusion and every report is prepared consistently. The benefits of strong accounting policies. Once a business begins following written accounting policies, the improvements become noticeable very quickly. First, financial statements become more consistent because every transaction is recorded using the same rules. This makes it much easier to compare monthly and yearly performance. Second, business owners make better decisions because they can trust the numbers they are reviewing. Accurate financial information leads to better budgeting, pricing, inventory planning, and cash flow management. Third, accounting mistakes decrease significantly. Employees no longer guess how transactions should be recorded because the rules are already documented. Strong accounting policies also reduce the risk of fraud. Clear approval limits, documented responsibilities, and regular reconciliations make it much more difficult for unauthorized transactions to go unnoticed. Another major benefit is that audits and tax preparation become much easier. Instead of searching for explanations, your accounting records already follow a consistent process that can be reviewed efficiently. Finally, accounting policies help businesses grow. As new employees join the company, they can quickly learn the existing financial system instead of creating their own methods. This allows the business to expand without losing consistency or financial control. If you found this video helpful, then like, share, and subscribe this channel to get future videos.